Ladies and gentlemen, good day and welcome to Venus Pipes and Tubes Limited Q3 and 9M FY24 earnings conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Pallav Agarwal from Antique Stock Broking Limited. Thank you, and over to you, sir.
Yeah, thank you, Viren, and good afternoon, everyone. Warm welcome to the third quarter results call of Venus Pipes and Tubes Limited. We have the senior management of the company represented by Mr. Arun Kothari, the Managing Director, Mr. Dhruv Patel, the Whole-Time Director, and Mr. Kunal Bubna, the CFO of the company. So I will now hand over the call to Mr. Arun Kothari for his opening comments. So over to you, sir.
Thanks, Pallavji. Good afternoon and welcome to everyone on the Q3 and 9 months FY24 earning call for Venus Pipes and Tubes Limited. I have been joined by Mr. Dhruv Patel, our Whole-Time Director, Mr. Kunal Bubna, CFO, and SGA, our Investor Relation Advisor. We have uploaded our Q3 and 9 months FY24 investor presentation on stock exchanges and company's website, and I hope you had an opportunity to go through the same. Today, I am proud to announce our company's robust quarter and 9 months performance for FY24. Revenues for Q3 FY24 stood at record high of rupees 207.1 crore, witnessing a growth of 52.2 with EBITDA margin standing at 18.9% for the quarter as compared to 12.9 in Q3 FY23. PAT for the quarter stood at rupees 23.3 crore, witnessing a growth of 106% on year-on-year basis. On 9 monthly basis, revenues stood at rupees 578.1 crore, surpassing our FY23 revenues by 5%. Similarly, margin stood at 17.5% compared to 12.6% for same period last year. The robust performance is on the back of multiple factors. Firstly, revenue contribution from high margin seamless pipe increased to 56% of our total revenues for the quarter from 45% for the same period last year. On the back of our backward integration, providing us an edge over our competitors, and additionally, anti-dumping duties on seamless pipe and mother hollow pipes, adding in heightened demand from organized players with high quality products offering. Secondly, export contribution increased to 17% of revenues from rupees 1.4 crore in Q3 FY24 to rupees 35.2 crore in Q3 FY24. This comes as a result of multiple things. Despite our relatively short operating history in the overseas market, the company has successfully forged a solid reputation, establishing itself as a trusted player in the export market. Backward integration of the seamless pipe has allowed us to make inroads with full potential in European market. We are also in constant talk to increase our presence across US, Africa, and Middle East, and we are confident to increase our exports basket and diversify to newer geographies. We have also appointed senior marketing representative for these regions. Our goal is to replicate the success we have achieved in Europe and extend our brand presence in USA, Africa, and Middle East. This performance is a mark of our unwavering commitment to innovation, quality, and customer satisfaction, along with integration of technologies. Domestically also, there has been a notable upswing in demand, resulting in increased inquiries and new order wins, resulting in increasing market share for the company. This trend underscores the sustained confidence customers place in our offering. Collectively, these factors signify a robust phase of growth and increase in opportunities within the domestic market. With the wide array of opportunity present in front of us, we plan to maximize on the same by increasing our geographical presence by building network and relationship and provide quality products to our clients in the domestic market as well. Expansion of market share by increasing our product SKUs and further diversifying across sectors such as oil and gas, pharma, food processing, power, effluent lines, and railways. Actively assessing the demand outlook and scaling up capacities as needed with a focus on achieving economies of scale. Prioritizing digitalization and technology integration, recognizing their pivotal role in fostering growth and enhancing operational efficiency within the company. Committing to sustainable practice, we will be installing 1.3 megawatt solar power system at our plant to reduce our environmental footprint. To give a few updates for the quarter, on the seamless front, following the successful completion of our capacity expansion in May 2023, I am delighted to announce that we have rapidly ramped up the operation and currently operating at an 80% capacity utilization. This achievement stands as a testament to the efficiency and effectiveness of our execution capabilities and quality of our product. Further anticipating high demand for seamless pipe, we had announced capacity expansion of 4,000 MTA per month, out of which 2,000 metric ton per month of seamless pipe commenced operation in Q3 FY24, and remaining 2,000 metric ton per month of capacity is set to commence in the Q4 FY24. With this, our total seamless pipe capacity will reach to 40,400 metric ton per annum by Q4 FY24. Lastly, I am happy to announce that we have received approval from leading oil and gas players in India and Middle East. This achievement is a result of our advanced capabilities in manufacturing higher diameter welded pipe. Being one of the select few in the industry with such capacity, we are confident in anticipating a significant upstick in demand and subsequent order inflow for welded pipe in the coming periods. These approvals are a testament to our quality offering and will help us increase our geographical and sector outreach. Looking ahead, there is a robust sustained demand expected for stainless steel pipes and tubes across various end user industries. As industries undergo expansion and modernization, the need for durable and high performance materials becomes paramount, further driving the demand for stainless steel. The path of growth for Venus Pipe Tubes is robust, and we actively strive to broaden our influence across various sectors. Our commitment to a prosperous future is characterized by the continuous expansion of our portfolio in terms of products, clients, and geographical presence. This strategic approach is designed to fortify our foothold in every industry we serve, driven by the potent combination of enthusiasm and determination. We are committed to building a robust, diversified foundation that propels us towards sustainable excellence. Now I will hand over the call to Mr. Kunal Bubna to take you through the operation and financial highlights for the quarter.
Good afternoon, everyone, and a very warm welcome to our earnings conference call. We take absolute pride in announcing that your company has reported highest ever quarterly revenue, EBITDA and PAT for Q3 FY24. On the revenue front, revenue from operation for Q3 FY24 stood at rupees 207.1 crore as compared to rupees 136.1 crore in Q3 FY23, a growth of 52% Y-on-Y basis. Revenue for operation for 9 months FY24 stood at rupees 578.1 crore as compared to rupees 376.1 crore during 9 months FY23, achieving a growth of 54% Y-on-Y basis. Our revenue has grown by 52% and 54% for Q3 and for 9 months respectively, despite softening of RM prices compared to previous period. If we compare on volume front, volume growth on welded pipe was more than 50%. For seamless, volume growth stood at more than 100% on Y-on-Y basis. Revenue bifurcation for the quarter was 41% from welded, 56% from seamless pipe, and 3% from other sales. Growth in the seamless segment was around 89% on Y-on-Y basis. Welded segment registered a growth of 39% for Q3 FY24 on Y-on-Y basis in terms of revenue. Our export sales stood at rupees 35.2 crore for the quarter compared to rupees 1.4 crores during the same period last year. On the gross profit side, gross profit for Q3 FY24 stood at rupees 60.6 crore as compared to 26.9 crore in Q3 FY23, a growth of 125.5% on Y-on-Y basis. On the EBITDA front, EBITDA for the quarter stood at rupees 39.1 crore as compared to rupees 17.5 crore for the same period last year. registering a stellar growth of 123% with EBITDA margin at 18.9%. EBITDA for 9 months FY24 is rupees 101.2 crore as compared to rupees 47.5 crore 9 months FY23, a year-on-year growth of 113%. PAT for 9 months FY24 is rupees 60.9 crore versus rupees 30.8 crore in 9 months FY23, a growth of 98% on Y-on-Y basis. The margin for the 9 months FY24 stood at 10.5% compared to 8.2% in 9 months FY23. PAT for the quarter stands at rupees 23.3 crore as compared to rupees 11.3 crore in the same period last year and rupees 20.3 crore in Q2 FY24, a growth of 106.6 Y-on-Y and 14.8 on Q1Q basis. This strong performance add another players to our competitive advantage. With solid financial capability, we are well equipped to weather challenges, invest in growth initiative and strategically position itself for market leadership. With this, I would like to open the floor for Q&A round.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Thank you for the opportunity and congratulations team for a good set of numbers. But I had two questions. So one was around the margin. So we've obviously seen a very good performance on the margin side. But when do we start seeing sort of a peaking, right? So do you think that there is more scope for margin expansion from these levels onwards? Or do you think that it will remain in the same range? That was my first question. Thanks.
Yeah, on the as we deal with two products, welded and seamless. So on the side of seamless, we have been achieving the required margin what we were targeting for this financial year for this quarter. So I believe definitely it should be in this range bound. But the intent is to definitely to pick from here also, because if you see for seamless, it was around 20 to 25% of export in this quarter standalone basis. For on the side of seamless, wherein the margin what we are earning is likely 3 to 5% higher as compared to the domestic direct sale earning. So I believe that is driving those margins, and for that we will the intent is to keep this margin intact and increase a bit. On the side of welded, I think as more and more higher sizes come into play going onward with also another capacity getting more utilized in the process, a bit of increase on margin side would be there on the side of welded.
Okay. And sir, with respect to the exports, right, obviously now we've come to a substantial level in terms of revenue contribution. But still, I think on the stockist side, there is a 27% contribution still there. So when do you start seeing that the stockist contribution starts to reduce substantially from here? So say, I'm just trying to guess that in 2 years, how will your mix of volumes start to look like?
Yeah, if you see from FY23 or earlier year, the percentage of stockage had been definitely decreasing. But I believe the intent is to keep it around 20% going forward. So I think in the coming financial year, we will be able to see those range bound number from the share of stockage and trader.
Okay. And sir, if you could just spell out your utilization number for this quarter. Thanks.
Yeah, it was basically on the side of seamless, it was around 85%, you can say, and on the side of welded, all the capacity taken together, it was in the range of 55, 57, 60% in the middle of that.
Okay. Thank you so much. All the best ahead.
Thank you. The next question is from the line of Sneha Talreja from Nuvama. Please go ahead.
Good afternoon, sir, and congratulations on a set of numbers. My questions are more pertaining on the exports front. Given the ongoing Red Sea, impact, are you seeing anything with respect to, exports? Are you materially facing any issues with respect to your supply, or is it still on the healthy curve?
Yes, basically those happened in the fag end of December only. So we were not much affected in the last quarter because of that. But again, also there is an effect on the size of a bit of freight cost, but there are mixed bag of order. We have FOR and CI both type of order. So, but I think that the volume and other, I believe it will be intact, what we are targeting for this quarter also. Bit of price effects are there on the side of Fed, but that is also very marginal.
Understood. And given the strong trajectory that you're seeing, strong demand, and you have also highlighted certain customer approvals that you've been getting, what's the target on the export front? Like, what could be your export share in the next 2 years?
It is at least we're targeting it should be at least 20% of our total revenue, and whatever beyond that we achieve will always be our intent to achieve more than that.
Understood. And any significant margin difference that you're enjoying today in exports versus domestic market?
Yeah, now we have been seeing keeping our presence getting more in exports, and we are able to get a margin of 3 to 5% higher as compared to what we sell in domestic side.
Understood. Thanks a lot, and all the very best. I'll get back in the queue.
Thank you. The next question is from the line of Kunal Kothari from Centrum Broking. Please go ahead.
Yeah, thank you for the opportunity and congratulations for a great set of numbers. So my first question is on the overall market outlook. How you see the realization paved in Q3 on sequential basis as well as on a year-on-year basis, and what is the outlook for the next quarter as well?
Yeah, basically, if you see on the pricing side, on the side of welded, there has been a decrease on the price by around, you can say, 12 to 15%. And on the side of stainless, there has not been much decrease, but it was there 3 to 5%. And see, if you compare Q on Q basis, it was marginally same, not much effect was there on Q on Q basis. But if I compare 9 months, this 9 months with last FY23, so 3 to 5% in case of stainless and around 12 to 15% on the side of welded, there has been a decrease. But I believe this should be maintained going forward also. There should be much, keeping the current scenario, it looks it should be pan out in this fashion only.
Does the price decline is related to any demand pressure, or what reasons do you see that there has been sharp decline in price?
Kunal, we can say that almost it's the international market only. The price of the other raw material is also decreased. That's why price is decreased in the market. Or there is a slow in demand in the chemical sector only mainly. In other sector, because since Venus has started Venus now has capability to manufacture all type of products, so we got the new approval also. So this year we have increased our market share in other than chemical also. Till last year our more focus was in the chemical sector, but this year we started to develop the new sector.
Okay. And what will be the current order book in hand and bifurcation towards the exports order book as well?
Hello.
Yeah.
Hello. We have an order book of 230 crore, and the export is around 20% of that.
Okay. Sir, lastly, want to understand similarly on our overall revenue share that towards stockists and traders. So if I compare on a year-on-year basis, we have increased from nearly 40 crores to 56 crores. So that is a tremendous growth that we are seeing over there. I of course believe that compared to direct sales and exports, the margins will be quite lower to them. Despite the growth towards the stockists and traders has been quite healthy. So what is the reason that we are not able to reduce our dependence on stockists and move towards the direct sales?
Kunalji, we are developing since almost we have done the capacity expansion of the 3 times of the earlier capacity, or we have increased the sizes and SKUs in all variety in the stainless steel pipe segment. So we are pursuing with the customers because for the almost new sizes and to target the new customers, we require that because our product is used in the critical operation, so we require the approvals from the clients also. So we are pursuing, our marketing team and our technical team is pursuing with all the companies to get the approval. So overall basis, in the volume terms, we are increasing our shares for the direct end user, but in the percentage term, we are almost equal level since our capacity has been increased substantially. So we can see in the next coming 2 quarters, it will also go down.
Okay. So is it safe to say that incremental volume growth that we will be having will be towards the direct sales and exports driven only?
Yes, Kunalji.
Okay. And what could be the margin difference? Can you also state that?
See, when we sell to stockists and traders, the margins are slightly low by 2 to 4%, you can say. But there are few orders also where you also get good rates also as compared to what you earn in direct sales, because we are able to cherry pick the orders with traders, stockists, and also on direct client base. So that way we counter those effects.
Okay, sir. Thank you so much. That's it from my side.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Shobit Singhal from Anand Rathi. Please go ahead.
Yeah. Thank you, and congratulations on a good set of numbers, sir. So I have a couple of questions. So one with respect to the welded pipe. So we have seen a very strong growth in the seamless side. So welded pipe, if I see last 5 quarters, average growth was just around 6%. So when do we expect it to ramp up to around 80-85% utilization levels?
Yeah, basically, see, we have been receiving approval, as we said, from some of the leading oil and gas company, also from few of the overseas clients. So that utilization level will definitely increase with each quarter to come. So I believe the next quarter would be incremental from what we have achieved for this quarter, or roughly 55 to 57%. And there will be increment in the next quarter. And I believe from the next financial year, those higher percentage should come into play. And each quarter would be having incremental utilization on the side of welded.
Okay. And so now our 400 metric tons per annum seamless capacity will be fully operational by Q4. So what will be the incremental CapEx that we would be incurring? And can you give any color on the new client addition that we have seen in this quarter?
There had been, mentioning a specific name, slightly competitive, but oil and gas we have added in pharmaceutical, we have added in chemical, we have added in engineering, we have added in paint. So there are mixed bag of sectors wherein the client addition has been done. And I think, post this completion of all this CapEx in this end of this FY24, from the next year, I believe there would be CapEx which will drive us a higher double-digit growth on the side of capacity, but should be in the range bound of, you can say, around 40 to 50 crore each year for the coming year, basically.
Okay. And last question, sir, if you can give the sector-wise breakup. So just wanted to understand how a percentage sales in the oil and gas or the other premium product category industry has increased year-on-year basis, or we are still in the same kind of tonnage basis on those industries?
See, chemical and engineering are definitely the predominant sector where we catered, but the sector which has increased the contribution is basically paint, you can say, pharmaceutical, power industry, a bit of oil and gas. So these are the few sectors, and railway a bit. So these are the few sectors which is added as compared to the earlier sector which were there.
Okay. Thank you, sir.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good afternoon, sir, and congratulations on a very good set of numbers. Sir, I just wanted to understand, once all of your expansion plan is completed and properly ramped up, what kind of the margins you are targeting?
See, as we said, for the seamless side, it is basically we were running around 60 to 63 rupees per kg in the FY23 target, and that is the intent. We should be more than 50% incremental on the side of seamless, and on the side of welded, which was 37-38 rupees, we target around 15-70% incremental on the side of welded. So that is the margin target for the going year for welded and seamless.
Understood, sir. Sir, also I wanted to understand our capital allocation policy because this year we are almost will be completed with one of these sharpest capex plan. So next year, as of now, we have just a small plan for the also mill. So how are we going to utilize the cash? Because next year our cash flow generation would also be incrementally better.
Yeah, see, basically, there are two things in it. One would be the capex requirement, what I've said in the range of 40 to 50 crore, and second would be increase turnover will lead to increase deployment of working capital. So what we see, there will be healthy cash flow, but I believe both the things taken together, the working capital and the increased capex, can easily be made from this internal source accruals what being generated. So the intent is to keep those accruals towards this working capital and capex requirement to be met.
Understood. So just one last question in terms of the capability side. Have with these facilities coming in, have we covered almost all of the seamless steel capabilities, or there are certain areas where we can work on and can further announce some capex? Basically, we are still importing certain premium goods from the foreign market. So any idea whether you want to go in that side, or by when we expect us to announce capex on those sides?
See, basically the intent were very clear to be making capex towards high margin products going forward. So there are a few sectors wherein there are specific grades of pipe required. There are some special grade of pipe also being manufactured, what we currently don't do both on the side of welded and seamless. So the intent is to to make those announcements going forward, wherein we can serve to specific sectors wherein those demands are there, where higher margins are there, also to manufacture specific grades of pipes which we don't manufacture or which we import. So definitely those intent are there, and going forward, the expansion would be more centric towards higher margin products.
Nothing finalized as of yet, right?
Yeah, definitely there are, but it is not. It won't be right to announce it currently. We are working on that.
Okay. So lastly, what is our made to order percentage in overall sales?
It will be around 80%. More than 80%.
Okay. More than 80% is made to order, basically.
Yes.
Thank you, sir.
Thank you.
That's all from my side.
The next question is from the line of Sahil Sanghvi from Monarch Network Capital. Please go ahead.
Yeah. Hi, am I audible?
Yes, you are audible.
First of all, congratulations for delivering what you have guided, and very good margin performance also. My first question was, so when you say 80% utilization in seamless, would that be on the 12,000 capacity, or would that be on 14,400?
It would be on 12,000. For next year?
Current utilization for seamless.
Yeah, it would be on the capacity as and when those are coming. On that basis, I am telling it is around 82 to 85%.
Okay, because we have commissioned that 200 tons per month.
Yeah, it includes that 200 ton also, which had come lately in the quarter. It includes that also.
So 80% on that, right? That
Yes.
included. Okay. My second question is, how do you expect the working capital, maybe the cash conversion cycle of working capital requirements to move forward? Because what happens is that our cash flow from operations still appear quite weak. I understand most of it is utilized in working capital. But now, since last 2 years, we had quite a steep ramp up in our volumes also. Next year, do you see some easing in the requirement of working capital? Can we expect some higher cash flow from operations? How do you expect that to?
Definitely, you're rightly to say next year there would be a good amount of cash generation from the operation. And see, there won't be much capex, and definitely last 2-3 years there was capex, there was increase all sides. But I believe coming FY25, and I think even if you see FY26, there would be a healthy cash flow generation from the operation. So which will be a marginally used definitely towards this capacity expansion, but which is not very high number, nor it is in 3-digit numbers. So apart from that, that balance leftover can easily be used for this working capital requirement for the business. And I don't feel there would be much issue in utilizing this, and there will be not much challenge on the side of cash flow also going forward with this healthy profit coming into the business.
Right. And would you be